Commodities trading involves buying and selling raw materials or primary goods such as oil, gold, natural gas, agricultural products, and metals. It's a key part of the global economy, allowing producers and consumers to manage price risks while giving investors opportunities to profit from price fluctuations. Commodities are traded in two main ways: spot markets and futures markets. In the spot market, commodities are bought and sold for immediate delivery. For example, a manufacturer might buy copper today at the current market price to use in production. In contrast, the futures market involves contracts to buy or sell a commodity at a specific price on a future date. For example, an airline might purchase oil futures to lock in fuel prices and protect against price spikes. Futures contracts are standardized and traded on exchanges like the Chicago Mercantile Exchange, CME, or Intercontinental Exchange, ICE. These contracts allow traders to speculate on price movements without physically handling the commodity. For instance, if you expect the price of gold to rise, you could buy a gold futures contract, and if the price increases, you can sell the contract for a profit. Commodities trading is influenced by supply and demand dynamics. For example, droughts can reduce crop yields, driving up prices for agricultural products like wheat or corn. Similarly, geopolitical tensions in oil-producing regions might decrease supply, causing crude oil prices to rise. Traders often use commodities to hedge risks or diversify their portfolios. Producers, such as farmers or mining companies, use futures to lock in prices and protect against losses if market prices drop. For example, a farmer might sell a futures contract for their wheat crop at $7 per bushel, ensuring a guaranteed price regardless of market changes. On the other hand, investors may use commodities to hedge against inflation, as the value of raw materials often rises when inflation is high. There are risks in commodities trading, including price volatility and leverage. Prices can change rapidly due to weather, politics, or economic trends, and traders using leverage can amplify both gains and losses. For example, a small price drop in a heavily leveraged oil trade could result in significant losses. Commodities can also be traded through exchange-traded funds, ETFs, mutual funds, or stocks of companies tied to commodities, like mining or energy firms. These options allow investors to participate in commodities markets without directly trading futures. In summary, commodities trading involves buying and selling raw materials, either in spot markets or through futures contracts. It helps manage risks for producers and consumers while offering profit opportunities for investors. Understanding supply-demand dynamics and using proper risk management strategies are crucial for success in commodities trading.